All the financial advisors, all the popular YouTubers, they're all lying to you. They all tell you to buy this here. This is the stock market, the S&P 500, which can drop by 93% over the span of 23 years. Now, you have never seen the S&P 500 in this chart, because this is not the regular S&P 500. You know the S&P 500 as this chart, or maybe as this chart. So that's simply the index in US dollars. And here is also the index in US dollars, but on a logarithmic scale, so that we can see the percent changes over time, not just the absolute changes. Still, those two charts are lying to you. This here is the real chart. Because here's the problem. If you just follow the popular advice to buy into the index regularly, maybe via an ETF, you're not optimally investing at all. Yes, the S&P 500 measured in US dollars is going up long term, but so is everything else. So is property, so is gold, so is anything that is not fiat currency. The sales pitch that's done for stock investing, we could do the same pitch for gold, for silver, for oil, for anything, for property, because it all goes up long term. So clearly this is not the asset going up. Instead, it's the US dollar going down. So this chart does not show us the truth. The US money supply grows by 6.8% per annum. So over the course of 66 years, because interest compounds, it grew by a factor of 77. There are now 77 times more US dollars floating than 2 generations ago. That's why the S&P is going up. That's why gold is going up. That's even why the GDP is going up. This might be controversial, but long-term indicators like the GDP should not be measured in US dollars. That goes down over time. I think this is done on purpose. I think that the people that are at the very top, they just make up numbers like this to let everybody feel good. Something that is measured over the decades should not be measured in US dollars. Here's the GDP relative to the US money supply. That peaked in 1997 and since then went down by 40%. Doesn't it explain why the average family with just one income earner has it now much harder to buy a house, why it's much harder to send your kids to college, and why the average Joe is struggling much more? The productivity measured in constant dollars without this devaluation, it actually has come down. And maybe you don't believe in the official USM2 statistics. Maybe you say that that's the number that's been made up. Maybe the USM2 money supply is not the right benchmark. But then measure the US GDP in gold. A little shiny rock definitely is not something that's more useful today compared to 100 years. Rather the opposite, right? There's a 2% mining of gold happening every single year. Yet the GDP measured in gold went down by 53% over the last 66 years. This is the official narrative, and this is what I believe is much closer to reality. People are struggling, and that can be measured if we just measure this right. Now, I don't want to turn this channel into something that deals with conspiracy theories, but I do think that measures like the GDP in US dollars make no sense. I also think that the official inflation numbers with the CPI also don't make much sense, because over time, consumer goods get cheaper and cheaper to produce. So of course the CPI is lower compared to our money printing, because we get technological progress. It's easier now to produce that TV than it was, say, 20 or 30 years ago. In theory, because we become more and more skilled and we have better and better technology, things should become cheaper over time. The reason why they don't become cheaper is because the monetary base expands faster than our technological progress. We don't improve with our technologies by 6.8% per annum, maybe only by roughly 3%. And that's where the delta between the money printer and the official CPI is coming from. But this is an investment channel, so I want to talk about investments. Now let's measure the S&P 500 in gold and not in an inflating dollar. And then we get that chart from the beginning. Then we get this massive price drop over 12, 13 years of 93, 94%. Measured in gold, the S&P 500 has massive volatility, and it can take a long time to get your money back if you enter the market at the wrong time. Now, there's different ways to look at this chart. maybe we're just going sideways very long term. And the S&P 500 protects against the money printer just like gold does. If that was the case, we would now be slightly overvalued, but there can be significant deviations from that equilibrium. But we could also make the argument that the S&P 500 actually does do better than gold. That productive capital does outperform a shiny rock, as Warren Buffett would say. But by how much? It's not that much. 630% of outperformance, or a 7.3x over the course of 142 years. That's how long that chart goes. That's an annual alpha of 1.4%. The productive capital beats the shiny rock by only 1.4% per annum. In the optimistic case, if we say that long term there is actually growth and that we should ignore this potential equilibrium theory. But let's play with that equilibrium theory for a second. Let's say we do go sideways over the very long term, because there is an argument to be made here, right? We can just go in line with gold over the course of 95 years. That's how long those two data points are apart from each other. Or let's have a look at those two data points. That's 93 years. So it's not that clear to me that the S&P 500 really long-term outperforms gold when there's such a long stretch of just the exact same performance. Yes, we could draw the lines differently and we could say, okay, we've got higher highs and we've got higher lows. And this was just a breakout. But this is now really a matter of taste. If those kind of lines are more representative than those kind of lines. Here's the thing that financial advisors and mainstream YouTubers don't tell you. We should not be opinionated about the asset class that we invest in. We should be opportunistic. We should be buying the thing that's at a particular point in time comparatively cheap and sell the thing that's comparatively expensive. We should actually ride the waves. We still should have a diversified portfolio, buy different things at the same time, but we should have a different weight per asset class given what's currently cheap versus expensive. The cheap thing should be overweighted. The expensive thing should be underweighted. We should not have a static weight for each part in our portfolio. And definitely, we should not just buy into one asset class. Because don't underestimate how massive those differences can be. This is an outperformance of the S&P 500 versus gold temporarily through a stretch of 20 years by 3,000%. Even a bit more than that. And this year, the S&P 500 crash in the 70s, the oil crisis, that led to the 93% underperformance versus gold. Those kind of moves matter. If you were mainly in the S&P 500 when it was at an all-time high versus gold, you then subsequently the next 10 years made a 90% drop. In other words, if you had the majority of your wealth in gold rather than the S&P 500 during that ride, you would have 10 times more capital. The same is of course true at the height of the dot-com bubble. But let's play with this argument here. The S&P 500 long-term outperforms gold. And so why even bother holding gold? Yes, there is some volatility, but if our time horizon is our children's grandchildren and we invest for the next 150 years, not just the next 100 years, then maybe we should only be in the stock market and not in the gold market. And maybe given that chart, let's be a bit less sarcastic, there's a potential for the S&P 500 to maybe outperform by 400% versus gold. And this was maybe just a little outlier. Is a 400% outperformance very realistic? I've got my strong doubts because the price to earnings ratio historically, the Schiller PE, that is close to an all-time high as well. A 400% increase. Let's say gold stays flat. That would mean a 5x. So a Schiller PE ratio of 200. Now, how likely is it that this chart will go to 200? That we're going to pay for the next 200 years of earnings with the price today? That's essentially what we do when we buy stocks, right? We buy the future earnings. But in this case, it would be 200 years of future earnings. This is a very long-term chart, by the way. It starts in 1871. I do not think that the S&P 500 will get a PE ratio of 200. Sorry, but I don't think that's realistic. And so thus, this scenario is also not realistic. I think this scenario, going back to our equilibrium, is much more realistic, a drop of 33%. And that would imply a PE ratio somewhere around here, right? The 25 mark, maybe a bit above that. And that's not even a very pessimistic case. We tended to drop more during .com and then subsequently during the global financial crisis. I think the bull case for stocks, it assumes that robots and artificial intelligence will take away 95% of labor and all of the gains will go to the capital holders. I don't think a PE ratio of 200 in the S&P 500 is realistic. I think a reversion to 25 is much more realistic. And this is where the mainstream media might even agree. But the mainstream media doesn't act on this, right? They don't look at charts like this. They don't discuss them properly. And again, I think that's because it's not in their best interest. Their best interest is that more people buy stocks because they see this chart. And the people that sell gold, they want you to see this chart. And the government that wants you to believe their lies, they want you to see the GDP chart like this. Nobody shows the S&P 500 relative to gold. Nobody shows the GDP measured in gold. Nobody tells you that the S&P 500 might actually just offset the money printing. The super aggressive 6.8% devaluation of the currency. This is not a video against investing in stocks or against investing in gold or property or whatever it is. This is a video against being too specific about one asset class. We do not want to be opinionated and just buy into one asset class. Most people have their favorite asset class and most of their wealth is either in stocks or maybe in gold, right? The gold bucks, maybe in Bitcoin or maybe in property, right? They had a good first experience with property. Maybe they only put 10% down and suddenly the property doubled in value. The return on equity was huge and so they just do property. That's also a mistake. We want to get into the asset class that at a particular point in time is cheap. We don't want to have our favorite asset class. I personally like Bitcoin, right? This is the Bitcoin strategy channel, but I don't have my majority of wealth always in Bitcoin. When Bitcoin is close to the all-time highs, when Bitcoin has a lot of short-term traders in it, I am okay to say this on this channel. And every time when that happens, like in October of last year, people always trash me because they say the Bitcoin rally wasn't even that advanced yet. The altcoins haven't rallied yet. Bitcoin will go to 1 million with this super cycle. And then, of course, people get disappointed because Bitcoin relative to other asset classes at that point in time was expensive. So really, what we want to do is we want to be opportunistic. We want to learn about all the asset classes. We want to have the ability to quickly invest into any of the asset classes. And then we want to get into the thing that's cheap and we want to get out of the thing that's expensive. At least relatively speaking, right? We still want to have a diversified portfolio, but we want to have much more weight towards the cheap thing. And that doesn't come automatically because if you already have an allocation to that asset class, and suddenly the asset class drops by 60, 70, 80%, then that allocation in your portfolio will also be comparatively smaller. So you have to actively sell the thing that appreciated and buy the thing that went down. And at the time, this feels very bad because it feels like we are selling our winner in order to buy the loser, right? We throw good money after bad money. But this is exactly what we have to do, right? It's exactly what used to work the best. The most important thing is to get this somewhat right. To measure assets against each other, like the S&P 500 versus gold, but we can also measure Bitcoin versus gold, Bitcoin versus the S&P 500, property in gold, etc. You will get similar kinds of trading ranges that will be very useful. And so if you want to know how to plot those relative valuation charts and where every single asset class sits against each other at the moment, then feel free to also get this free report. So that's the continuation of this video. You can get it either via Telegram, so click over here, or scan this code, or you can get it via email. Just plug in your email. There's no payment required, no credit card required. It's completely free. The link to this, again, is in the pinned comment down below. If it's your first time here, feel free to subscribe. I publish here regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time. Cheers.